My introduction will just be a brief note of thanks. Bill, we've known you for several years thanks to our getting to know each other by virtue of the New York program. We met 3 or 4 years ago when our students were interning at Goldman Sachs, and thanks to one of our alumni, Doug Fuge, he was able to arrange Bill and I to get together. I introduced him to the program and so forth, and we've known each other ever since. He's been a friend of the university and a friend of the program. A couple of years back, he hosted our interns in the Federal Reserve Bank. Bill, it's a great honor and privilege to have you here and to welcome you to our campus. You've met with another group of students today, and as I'm sure you know now, and I can certainly speak from experience, Washington and Lee, it's just a wonderful university. It's a great place to work. It has wonderful students and superb colleagues, and it's a fantastic educational setting. We're all looking forward to your remarks this evening. And so without further ado, it's my pleasure to welcome William Dudley to the podium, 10th President of the Federal Reserve Bank of New York.
You followed instructions, Mark. Thank you. I have to say I'm completely sold after my tour of Washington and Lee University, a library that's open 24 hours a day, no excuses, not to do your assignment. A terrific, really impressed by the honors rules in terms of how the tests don't need to be proctored because there's an honor system in place. So it sounds like an absolutely terrific place. Now, it's sort of awkward for me to be addressing you on April Fool's Day, but at least it's good in one respect. If the forecast, what I'm going to tell you doesn't turn out to be true, I can just come back a year from now and say, well, April Fools. Thank you, Mark, for that kind introduction. It's really a great opportunity to speak here today. I'm following in the footsteps of a lot of other central bankers who have spoken here, and H. Parker, we owe him a debt of gratitude because the Federal Reserve System, as we know it today, probably wouldn't have been in existence if he hadn't had his foresight. The past few years, as you know, have been a very extraordinary time for policymakers. And we've responded by being very aggressive in the support that we've provided to the economy. And it now appears that a sustainable recovery is underway. However, the headwinds created by the collapse of the U.S. real estate market and its consequent damage to the financial system and household balance, it seems unlikely that the recovery is going to be as strong as we would desire. As a result, the substantial amount of slack in productive capacity that exists today will likely be absorbed only gradually. As a consequence, trend inflation, at least over the near term, should remain very low. And this is why the Federal Open Market Committee, or FOMC, concluded at its last meeting, and I quote, "Economic conditions, including low rates of resource utilization, subdued inflation trends, and stable inflation expectations are likely to warrant exceptionally low levels of the federal funds rate for an extended period." What I'd like to do today is explain in some detail the logic underlying this expectations that economic conditions will warrant exceptionally low levels of the federal funds rate for an extended period. This conclusion stems in part from the observation that the current economic environment is qualitatively different from previous post-World War II business cycles. Most post-war recessions were preceded by high rates of resource utilization and rising inflation. This prompted a tightening of monetary policy, which in turn dampened interest rate-sensitive spending, particularly on housing and consumer durables. Then, as inflation pressures subsided, monetary policy was eased, and the interest rate-sensitive sectors, which were depressed, rebounded, often quite sharply. The current business cycle is different in one important respect. It was preceded by a global financial crisis. The crisis was due in large part to excessive leverage and excessive investment in real estate assets, and unfortunately it will take time to unwind these excesses. Today I'm going to offer a framework for assessing the forces that have shaped the recent performance of the U.S. economy. This framework will provide some context to the fiscal and monetary policy responses to what is now called the so-called Great Recession. Then I'm going to discuss the economic outlook for the United States over the next year. But before I proceed any further, I want to emphasize that these views are mine and mine alone and do not necessarily reflect the views of the Federal Open Market Committee or the Federal Reserve System. I say that every speech. So I want to start by building an analytical framework. Say's law, which was named after the French economist Jean-Baptiste Say, states that the aggregate value of incomes earned in an economy over some period of time must by definition equal the value of all goods and services produced over that same time period. Or put somewhat differently, on an ex post or realized basis, saving must equal investment. Investment in this case means current spending on new physical, human, and intangible capital. This insight of Say's law is the conceptual basis for the national income accounts and the gross domestic product statistics that we follow so carefully. Even so, economists have been debating the implications of Say's law since it was first expounded. Classical economists argue that this ex post balance would occur in a way that kept the economy quite stable at full employment. If there were shocks to savings or investment spending that pushed the economy away from full employment, prices and wages would adjust quickly, providing the market signals needed to bring about the reallocation of resources required to restore full employment. The global depression of the 1930s raised serious questions about this classical theory. Although savings must equal investment on an ex post basis, the two can diverge ex ante potentially sharply. For example, when ex ante or desired savings exceeds ex ante or desired investment spending, inventories rise above desired levels. If the prices of the products in question do not fall sufficiently rapidly so that this unwanted buildup of inventories is sold quickly, then production and employment must fall. Perhaps most famously, John Maynard Keynes, in the General Theory of Employment, Interest, and Money, argue that there are institutional rigidities that inhibit price and wage flexibility. This means that periods in which ex ante saving exceed desired investment might lead to periods of persistent unemployment. In this respect, the financial system plays an important role. Financial intermediaries, after all, match savers and borrowers. If the financial system is under stress and lending standards are being tightened, then ex ante investment is likely to decline because people can't get credit relative to savings, all else equal. The financial intermediation process and the creation of credit is the primary channel through which monetary policy affects the economy. By influencing the volume of credit, monetary policy strives to keep ex ante savings and investment in rough balance. Too rapid a pace of credit creation would overstimulate investment relative to savings, potentially increasing the rate of inflation, and this in turn could damage the economy's long-term performance. On the other hand, too slow a pace of credit creation would likely lead to an ex ante shortfall of investment relative to savings, causing unemployment to increase. So monetary policy is trying to strike that balance. This analytical framework also applies to the global economy, but with an added level of complexity. At the global level, income equals output and savings equals investment on an ex post basis. However, for an individual country, savings can exceed investment, or alternatively, production can exceed domestic demand, with the country's exports exceeding the country's imports. This requires that for some other set of countries, investment must exceed savings, or alternatively, domestic demand must exceed production, and imports must exceed exports. What this means is that what happens abroad in terms of desired savings and investment also influences the performance of our domestic economy. Now, this framework, I think, provides a simple way to evaluate the recent economic environment and the current economic outlook. When desired investment rises relative to savings on an ex ante basis, then the economy tends to strengthen. If the strengthening persists, inflation may rise to levels above what is regarded as consistent with maximum sustainable growth and full employment. This was the story for much of the 2004-2006 period. The Fed responded to rising trend inflation by tightening monetary policy to keep the economy from overheating. In contrast, when inflation falls relative to savings on an ex ante basis, an economy weakens and may slip into recession. And this was the case between 2007 and mid-2009. During this period, the Federal Reserve tried to support the economy by cutting its federal funds rate target to nearly zero, by creating a number of special liquidity facilities to support the extension of credit, and by engaging in a large-scale asset purchase program, buying treasuries, agency debt, and agency mortgage-backed securities. Now, an economic recovery requires that desired investment must rise relative to savings. And this has happened recently as fiscal stimulus and an inventory of cycle have led to a fall in ex-ante savings relative to investment. But for the recovery to strengthen further, this process must continue. There has to be some further demand impulse, be it a decline in household savings rate, a rise in business investment relative to profits, a further expansion of fiscal stimulus, or an improvement in the net trade balance by an increase in exports relative to imports. So let's now apply this framework to evaluate what happened over the past decade and what it implies for the economic outlook. The last 3 decades have been marked by a shortage of U.S. domestic savings relative to investment. The United States has almost continuously run a current account deficit since the early 1990s. I have to make sure I know how to page forward here. Remind me? Okay, great. Yeah, there we go. I was looking on the screen and I should be looking at the keyboard. This is slide chart 1 that looks at the current account balance. And you can see the U.S. current account balance deteriorated quite sharply from the 70s to the 90s, and by 2005 and 2006, the current account deficit averaged almost 6% of GDP. Now, interesting enough, during that period, the exchange value of the dollar didn't change very much. It's not very different now than what it was in the early 1990s. So what this means is that the massive flow of savings into the United States from around the world occurred voluntarily. People wanted to invest in the United States, and that desire for investment in the United States offset the fact that we were seeing a very large inflow of dollars from abroad. In addition to its sheer size, this inflow of savings in the United States is significant in several other respects. First, note the direction of the flow. One might expect that capital would flow from the developed world to the developing world, but just the opposite has been the case. In addition, foreign savers have been willing to lend to the United States in U.S. dollars. This means that foreign savers are exposed to the exchange risks that the dollar's value might change relative to their own currencies. Finally, one might expect that over time, as their holdings of dollar-denominated assets accumulated, foreign savers might demand higher interest rates. But in fact, U.S. interest rates, both in nominal and real terms, have been generally declining over the past 3 decades. These facts are at odds with the prevailing view that spendthrift U.S. consumers and the U.S. government are pulling those savings into the U.S. Indeed, for some time, there was a view of the twin deficits that held that large fiscal deficits in the United States were causing the large U.S. current account deficits. However, even when the federal government ran surpluses in the late 1990s, we still had large current account deficits, and those current account deficits continued to increase. This suggests that the link between fiscal deficits and capital inflows from abroad is not as strong as commonly believed. Before proceeding, a few important qualifications are in order. First, despite the fact that there's a large flow of foreign savings into the United States, our international financial position does not appear precarious at the present time. The U.S. has lots of investments in foreign countries, and the income from these U.S. investments abroad still exceeds the income generated by U.S. assets owned by foreigners. Part of the reason for this is that U.S. firms operating abroad earn higher rates of profit than foreign firms operating here in the U.S. In addition, the fact that interest rates right now are very low minimize the cost to the United States from the fact that we have a substantial negative net debt position. In addition, the fact that our foreign indebtedness is for the most part denominated in our own currency is a huge advantage in the event that the dollar were to come under significant downward pressure. That is because a decline in the dollar would raise the value of the income earned on our foreign direct investment in foreign currency denominated assets relative to the income that foreigners earned on their dollar denominated investments in the United States. All else equal, a dollar decline would boost our net investment income balance. Now note that borrowing per se is not necessarily a bad thing. So the fact that we're borrowing money from abroad, that's not necessarily a bad thing. The key is what that borrowing is used for, to finance consumption or investment. And if it's used to fund investment, it's also important how productive that investment turns out to be over time. So the question is, what did we do with that inflow of foreign savings? Well, we invested a substantial volume of that in physical capital, particularly residential and non-residential real estate. It seems clear that one important factor behind this investment was the decline in long-term interest rates. For example, from 2003 through 2005, mortgage rates declined to just under 6% on average, the lowest level since the first half of the 1960s. These lower mortgage rates were capitalized into asset prices. Rising prices for residential and non-residential real estate assets induced entrepreneurs to produce more of these assets. And in the housing market, this increase in prices was helped along by a relaxation of loan underwriting standards, which made it easier to obtain a mortgage and become a homeowner. Credit growth, interesting enough, was strongest among households with relatively low credit scores. Chart 4 divides households by quintile in terms of credit score. And what you see here, if you look at the fourth row, the fourth quintile, so that's people in the 60 to 80% quintile in terms of credit score, their credit grew the most over the 2005 to 2008 period. So it was really the easing of credit standards that led to the very sharp increase in credit outstanding. As a consequence of that easing of credit to low and moderate income households, the home ownership rate rose after being relatively stagnant for 2 decades, and that's shown in chart 6. The increased availability of credit to lower income borrowers and the sharp rise in housing values contributed to the rise in consumption as a share of GDP and a decline in the personal savings rate. As households felt richer, as their homes went up in value, they decided to spend some of that wealth in terms of consumer spending, and the savings rate declined as a consequence. Now, with the aid of hindsight, it's pretty clear that we built too many houses and we invested in too much commercial real estate, and we overvalued the prices of both significantly. The market overshot for several reasons. First, there was rampant speculative behavior. The longer that the asset prices continued to rise, the stronger the belief was that they would keep rising in the future. Second, the rise in prices reinforced the initial relaxation of underwriting standards. When prices are rising and credit is freely available, loan losses are low, and so people thought that this lending was not very risky. A homeowner in this kind of environment who had difficulty servicing the debt could typically sell the home for a profit and pay off the loan. Third, the boom was fueled by new financial products such as collateralized debt obligation, or CDOs, that were backed by subprime and Alt-A mortgages. Investors misunderstood how risky these products were, and this resulted in lower mortgage rates for non-conforming residential mortgages and lower funding costs for commercial real estate borrowing. And of course, that contributed to the increases in prices in both residential and commercial real estate. In the housing sector, these factors interacted to create a strong reinforcing dynamic. Relaxation of underwriting standards that made it easier to become a homeowner, and the lower mortgage rates, supported in part by the new financial products, made it easier to speculate in real estate. Moreover, as home prices rose, household net worth increased, making households more willing to consume a greater share of their current income. Now, not surprisingly, with the benefit of hindsight, this bout of speculative fever ended badly. Eventually, the supply of houses caught up with and then vastly overshot demand. Easing underwriting standards to support demand could only go on for so long. Prices turned down. At the national level, home prices peaked in late 2005 to early 2006, with commercial real estate prices peaking about 1 year later. You can see in Chart 8 how big the decline has been. From their peaks, home prices have fallen by about 30% on average, with much larger declines in some areas, while commercial real estate prices have fallen about 40% on average. Now, as these price declines intensified, the numbers of serious mortgage delinquencies surged and, in fact, continued to rise. This is shown in Chart 9. Research indicates that in 2007, the percentage of non-prime mortgages that went into default within their first year rose to 10% compared to 3% of such loans originated in 2003. While falling home prices appear to be the primary factor explaining this sharp increase in early defaults, most of the increase cannot be explained by traditional risk factors. One potential explanation is that individual home buyers often falsely indicated on their mortgage applications that the property they were buying would be their primary residence. Using an extensive set of data on loan performance that we have developed with Equifax, we find that it's multiple first mortgage lien holders, in other words, people owning more than one house, that account for a lot of the deterioration in delinquencies. As shown in Chart 10, you can see that people owning more than one home account for about 40% of the dollar volume of single seriously delinquent mortgage balances. Now, that compares to only 5% in 2004. As delinquencies and foreclosure rates rose, structured finance products backed by riskier mortgage loans performed particularly poorly. The securitization market for non-conforming mortgages collapsed. Credit availability tightened as underwriting practices became much more restrictive, even for plain vanilla mortgages. The cascading effect of the sharp increase in mortgage delinquencies and the resulting steep decline in the market value of mortgage assets was a key contributing factor to the financial crisis. As the financial crisis intensified and the economic outlook deteriorated, equity prices eventually declined by 50% from their late 2007 peak, before bottoming out about 1 year ago. But while the value of the real estate and equity assets were plunging in value, the debt incurred to acquire those assets remained, leaving households very highly leveraged. According to the flow of funds accounts, the ratio of household liabilities to net worth rose from about 20% to nearly 30% in just 3 years. You can see that really sharp spike in the ratio of household liabilities to net worth in a very, very short period of time. The result was a sharp decline in desired investment relative to savings. The number of housing starts plunged, commercial real estate investment fell, and households cut back on their spending as their net worth plummeted. The economy slumped in what is now called the Great Recession. Now, according to the Business Cycle Dating Committee of the National Bureau of Economic Research, these are the people who decide what's a recession. The U.S. economy has experienced 10 recessions since 1950. The duration of these previous recessions averaged slightly less than a year, during which real GDP fell by an average of about 1.75%, and the unemployment rate increased on average of a little bit over 2 percentage points. Relative to this, the Great Recession was far worse. From its peak, real GDP declined 3.8%, more than double the average decline of prior downturns. The unemployment rate began to increase in the second half of 2007, and over the next 2 years it increased by 5.5 percentage points. The rise would have been even more pronounced except for the fact that the average work week and the labor participation rate declined unusually sharply. So rather than people losing their jobs, people just left the workforce altogether, or they worked a lot fewer hours. And if you hadn't seen those sharp declines in average work week and in labor participation rate, the unemployment rate, the measured unemployment rate, would have gone up much, much higher. Overall, total hours worked in the non-farm business sector declined a staggering 10.6 percentage points. In addition to the decline in the demand for labor, the manufacturing capacity utilization rate declined to 65.1% in June of 2009. That's the lowest level of the post-World War II period. The result is that the output gap, in other words, the difference between actual output and the output that we could achieve at a full level of resource utilization consistent with price stability, climbed very sharply. This, in turn, has put downward pressure on trend inflation. For example, on a year-over-year basis, the core inflation rate declined to 1.5% in January 2010 from nearly 3% in the fall of 2006. So what about the road ahead? Well, fortunately, the U.S. economy is very flexible and resilient. Although it does not adjust as fast as the classical economists envisioned, in the United States, prices and wages respond relatively quickly. Moreover, policymakers have been aggressive in supporting the economy by easing monetary policy and by implementing a large fiscal stimulus package. As a result, although the unemployment rate remains unacceptably high, output has begun to expand again, and we appear to be on the verge of seeing sustained growth in employment. We'll know more about this tomorrow when the March employment figures are released. Equity prices recovered sharply, and home prices and commercial real estate prices appear to be stabilizing. Household indebtedness is declining due to a combination of debt repayment and the fact that lenders are writing off credit. They're writing off bad loans. After falling off a cliff during the first half of 2009, U.S. trade is improving. Both U.S. exports and U.S. manufacturing output have expanded very rapidly over the past 6 months. Although these are very encouraging developments, I believe that the recovery, though, is going to be quite muted compared to past recoveries. And this comes back to the framework discussed earlier. For faster growth, we need ex-ante investment to rise relative to savings, and ex-ante spending to rise relative to the current trend of income. But it's difficult to see where this impulse will come from in the near term. The early stages of past recovery have been led by consumer spending, particularly for durable goods and for housing. For example, in the first year of recovering following the deep recessions of 1973-75 and 1981-82, real consumer spending increased an average of 6.5%, and residential investment rose an average of 38%. It's unlikely that we're going to experience this type of strength this time. Households have suffered unusually large shocks to both income and wealth and remain highly leveraged, as shown in chart number 18. And although the household debt to net worth ratio has declined considerably from its peak, it's still around 26%, which is well above the average of the past decade, shown in slide 19. Moreover, even if consumers want to borrow more, credit availability is still constrained, and underwriting standards remain relatively tight. Real consumer spending increased at a 2.25% annual rate over the second half of 2009, and looks to be growing only slightly faster than that rate in the first quarter of 2010. Now, given that personal savings rate is still relatively low, it'll be hard for consumer spending to grow more quickly without large increases in real labor income. But big increases in real labor income won't be possible without a much stronger recovery in output. And a much stronger recovery in output is unlikely without stronger consumption. So that's our dilemma. Residential investment did increase over the second half of 2009, boosted by relatively low mortgage interest rates, lower home prices, and the first-time homebuyer tax credit. But recent data on the housing sector indicates that the recovery has stalled, as shown in slide 20. As with consumption, we're unlikely to see this typical surge of housing starts and residential investment that was a key feature of most past recoveries. That's because there's already a unusually large volume of vacant homes for rent and sale in the market, shown in slide 21. More are likely to come onto the market in the months ahead due to the large volume of mortgage loans currently in the foreclosure process. For the government sector, large federal budget deficits are constrained, and fiscal policy is slowly shifting from an expansive policy back towards restraint. At the state and local level, the constraints are even more binding, as budgetary gaps will need to be addressed by spending cuts and tax increases. As you can see in this slide, state receipts were pretty stable over the last year, but only because there was a surge in aid from the federal government to the states. That surge in aid from the federal government is going to be temporary, and if you can see what's happening to receipts ex grants, they have actually plummeted quite sharply. Exports have rebounded sharply over the second half of 2009, particularly to the emerging world. However, domestic demand in Europe and Japan, which are important export markets for the United States, remain very weak. This suggests that the U.S. trade balance is unlikely to change very much over the next year or two, and thus will likely be relatively neutral in terms of its impact on growth. Only business fixed investment is in a position to be a true locomotive of growth. Profits have stayed quite high relative to investments, and corporate balance sheets are awash with cash. But however, even here, the growth impulse is likely to be weak. Prospective startup businesses are going to find it hard to obtain funding, and larger businesses will be unlikely increase investment spending sharply at a time that capacity utilization rates remain unusually depressed, as shown in slide 26. Now, relatively sluggish growth implies that the output gap that we developed during the Great Recession will be closed only gradually. And this suggests that inflation pressures will stay subdued. The excess supply of housing is putting downward pressure on rents, which represents a large share of the consumer price index, shown in chart 27. In addition, unit labor costs have declined sharply over the past year due to the combination of unusually rapid productivity growth and slowing labor compensation growth. As shown in slide 28, we're seeing a very, very sharp decline in unit labor costs. Unit labor costs are declining at almost a 5% annual rate. Fortunately, longer-term inflation expectations remain well anchored. Most of the time when we say that, we're glad that inflation expectations aren't going up. But in this case, we're actually glad that inflation expectations aren't going down, because inflation is a function of the output gap and inflation expectations. The output gap is putting downward pressure on prices. Inflation expectations, because they haven't fallen, is actually holding inflation up. Chart 29 looks at one measure of inflation expectations based on the difference in yields between nominal Treasury and Treasury inflation-protected securities. And what it shows is, if you look at the 5 to 10-year line, the green line, that's people's expectations based on the TIPS nominal Treasuries differentials of what inflation is going to be 5 to 10 years out. And you can see here, it's been in the 2.5–3% range pretty consistently over the last 3 years. That's actually helpful in this environment because we really don't want inflation to fall any further. So what are the lessons to be learned from all this? Well, we've just lived through a period in which rapid increases in asset prices led to a serious misallocation of resources and a severe financial crisis. So the first question we need to ask, I think, is what do we need to do to minimize the likelihood of avoiding this type of experience in the future? As I noted in a recent speech, we face 3 major challenges that will determine how smooth this economic expansion turns out to be. First, we need regulatory reform that makes our financial system more stable and resilient. This requires many steps. That's be a whole other speech. But some of them very, very important ones are systemic risk oversight and solving the so-called too big to fail problem. In this respect, we also need to think hard about what we can do to prevent the type of speculative asset bubbles that occurred from causing so much damage in the future. In particular, we need to ask the question, are there macro potential tools that the Federal Reserve and other regulators could use to limit leverage and speculation and thus prevent the type of asset price booms and busts that have proved so troublesome? Second, we need viable exit strategies from this recent period of monetary and fiscal policy stimulus. Now, on the monetary policy side, we've been working pretty hard to ensure that we have the tools in place so that we can effectively tighten monetary policy when the time is right, even with an enlarged balance sheet. And third, we need a rebalancing of global economic growth. I was in Beijing last week, and so we had a lot to talk about on that subject. What this means, I think, in terms of global rebalancing is a smaller share of consumption relative to GDP in the United States and offsetting shifts in Asia. Circumstances have improved considerably from where they were a year ago, but job creation is still much too slow, and we still have much to do on the regulatory side to make our financial system more resilient and robust. I want to thank you today for having me here to your fine campus, and thank you for your kind attention, and I would be very happy to take a few questions.
If you would like to ask a question, please flag down one of the people with a mic so we can all hear you. Is Sai Moshiri here in the yellow shirt?
We have a very large balance sheet. The Federal Reserve balance sheet today is about $2.3 trillion, and the balance sheet's becoming large in part because we've engaged in a large-scale asset purchase program. I'm just giving you a little background to this question. We bought treasuries, agency debt, and agency mortgage-backed securities, and in that purchase process and the enlargement of the balance sheet, we've vastly expanded the amount of excess reserves in the banking system. Now, we have a tool to manage monetary policy even with a large amount of excess reserves in the balance system. We now have the ability to pay interest on excess reserves, and by doing so, we can induce banks to hold the reserves with us if we need to, rather than lend all those reserves out and create a credit boom. That's the belt. We're also in the process of developing a pair of suspenders. We want to make sure that people understand that we have the ability to exit from our enlarged balance sheet smoothly without creating an inflation problem. And so we're in the process of developing two tools that will allow us to drain a large amount of excess reserves from the banking system. One is a reverse repurchase agreement program where we would basically borrow money from investors like money market mutual funds, so they basically would invest with us. And by doing so, that would drain reserves from the banking system. The second facility that we're developing to drain reserves from the banking system is to induce banks, rather than hold their reserves with us on an overnight basis, to set up term deposit accounts where they would actually hold term deposits with us rather than overnight reserves. So both these tools are in the process of we're doing all the operational work now so we can implement these as soon as needed. Now, it's very important to recognize that us developing these tools is very different from when we're actually going to decide to tighten monetary policy. And people shouldn't take any signal about the possible timing of tightening monetary policy in terms of us developing these tools and testing them. We're testing them so that they're available to work as soon as they possibly could be needed. But, as I said at the beginning of the speech, we think that given the economic environment, where inflation is, where inflation expectations are, that we expect that the federal funds rate can be exceptionally low for an extended period.
In the very middle of the room there, in the yellow shirt. Speak loudly.
I don't think there's I don't think like we're enriching the banks by doing this. Remember, for every dollar of excess reserve that we've created, we have an asset that's earning income on the other side. And right now we're paying 0.25% on the interest on excess reserves, and we're earning 4.5–5% or so on the agency mortgage-backed securities portfolio that we've used that money for. So the reality of the situation is that right now our asset purchase programs are actually generating profits that the Federal Reserve at the end of the year remits to the U.S. Treasury. So I don't think that there's any question that we're somehow helping banks enrich themselves. I think it's more fair to say that the Federal Reserve is funding themselves at low cost and investing in higher earning assets.
To the extent that you're able, given the sensitivity with which your remarks will be interpreted, can you speculate or identify any broad macro trends that you would say must transpire before we encounter a more propitious labor market?
Well, I think, of course, I'm a central banker. I cannot speculate. I think that's what's going to happen is there's going to be a gradual healing process that's going to occur over time. The labor market had large job losses last spring and going into the summer, then more modest job losses. Last few months, the job losses have been very, very, very small. And I think certainly within a few months, if not with tomorrow's report, we're going to start to see employment gains. So I think the situation is gradually correcting itself. Now, it would be nice if we could wave a magic wand and generate a stronger recovery and get even more job gains. I mean, that's what we would really desire. But we've really applied a lot of stimulus to the economy. So we're sort of sitting with our both feet on the accelerator already. So I think we're just going to have to understand that time is going to have to pass and the economy is going to gradually cure itself. The view at the New York Federal Reserve is that things will be better this year than last year. There'll be job gains this year. There were job losses last year. And that 2011 is likely to be better than 2010 because what's happening is the financial system is gradually repairing itself. And as the financial system gradually repairs itself, as the household sector gradually deleverages, as the houses that have to be foreclosed on are foreclosed on, the excesses in the system will gradually get worked out. And as that happens, the stimulus monetary policy that we have today will gradually show through, and we'll see a stronger and stronger economy. But it's going to take time.
I just wonder if you could speak to the gradual winding down of all these liquidity programs the Fed has been running and how you foresee that's going to, I guess, impact the economy and even the market. Thanks.
The Fed engaged in a lot of special liquidity programs during the crisis. Essentially what happened was first we provided a lot of liquidity programs to the banks, and then when the banks became impaired and were unable to lend to the rest of the economy, we went around the banks and developed liquidity programs that provide liquidity directly to end borrowers, like the commercial paper funding facility, where we basically bought 3-month A1P1 issued commercial paper from U.S. Corporations. What we did when we introduced these liquidity facilities is we priced them at rates that were high in normal times but low in a crisis. So in the crisis, these liquidity facilities were extremely attractive. And so there's a big surge of activity into these liquidity facilities in the midst of the crisis. But as the crisis period subsided and interest rates in the market normalized, we didn't change the rates that we were charging. Our rates went from very attractive to unattractive. And as that happened, the uses of our facilities, liquidity facilities, dried up automatically because people thought they were too expensive at that point. So when we actually exited from our liquidity facilities programs in the first quarter, the actual usage of the liquidity facilities by that point was really, really small. So the market reaction to the end of the liquidity programs was no big deal because I can get funding in the market at a lower price than what the liquidity facilities would charge me. So far at least, I'd have to say that the liquidity programs were very successful, both in terms of how they supported the functioning of the financial market during crisis, how they wound up sort of automatically as market conditions normalized, and how they wound up in a way so that the end of them was not disruptive to either financial markets or the economy. Yes.
The second row.
Well, I think I'm going to leave that to Treasury, the administration, and Congress how to work it out. But I think it's, as I said in my remarks, that one thing that we have to work on is the exit strategy from both monetary policy and fiscal policy. Now, I think it was clearly appropriate that there was fiscal stimulus during the downturn because that actually helped support economic activity. But there's no question that the U.S. can't run very large fiscal deficits indefinitely. So there's going to have to be an exit from this period of fiscal stimulus, eventually. And I think it's going to be very, very important that Congress and the administration develop a plan that's credible on that score.
Yes, in the front row. We have time for probably 2 more questions. I guess
You mentioned the commercial paper facility.
The problem with that is that I was running the markets group at the Federal Reserve, and most of these liquidity facilities were either developed or operated out of the markets group. So it's like saying, which of these liquidity facilities is your favorite child? And I create people in New York who worked on these different liquidity facilities are going to get mad no matter what I answer. So let me not pick one. Let me pick two. I think that the commercial paper funding facility was hugely important in restoring market function to the commercial paper market in the deep depths of the crisis in the fall of 2008. And I think the term asset-backed securities lending facility, which we introduced in early 2009, was very, very important in restoring securitization activity in the consumer asset-backed securities market, so like the credit card market, auto loans, et cetera. So, I love them all, but those were probably my two favorites. Well, I think it's fair to say that there is concern in the marketplace about the deficit trajectory for a number of different countries, and as a consequence, investors are somewhat less willing to supply credit on the terms that they were willing to supply credit even as recently as a few months ago. So that's sort of a little bit of a warning signal to those countries that they need to start to get their fiscal house in order. So far, at least, there's not really much sign of real concern about the U.S. Long-term interest rates are still very low. Inflation expectations are stable. The dollar, if anything, has actually firmed a bit against the euro. But I would say that we shouldn't assume that we can go on the path that we're on indefinitely. And have those conditions stay in place. So eventually, we need to take action as well. So it is something to be concerned about because it's much better if the governments act in a timely way to put forward a credible fiscal plan than it is for the markets to behave really badly. Because if the markets behave really badly, that's going to be a negative for the economy. If long-term interest rates go up because investors are worried about the fiscal outlook, that's going to be bad for economic growth, which is going to be bad for the fiscal outlook. So it's important for the policymakers to respond in a timely fashion. Better to respond early rather than not so much that you have to tighten fiscal policy early, but I think you need to come forward with a credible fiscal plan early to reassure people that the long-run path, is sustainable. Okay, thank you very much.